I would like to share with you about the FNR way for dollar cost averaging. The FNR way for dollar cost averaging is not an approach that is fixed by time for each month or week. So it's accumulation at specific price determined by support and resistance. So the difference between the SNR way for DCA and the traditional DCA approach is that one is based on fixed time and the SNR way is based on a fixed price. So some of the advantages you get by using the SNR way for DCA is that you avoid accumulating during a strong downtrend, and when you accumulate there might be a high likelihood of an uptrend as well, and this can help you to build larger position size at more controlled favorable prices. Here is an example of a traditional fixed time DCA plan. So every month you will want to buy $1,000 of fruit at a fixed time, and this ignores whatever the price level is at. So on the 15th of January, the price is over here and you will buy $1,000 of fruit at this price. On the 15th of February, you'll buy another $1,000 at this price. And on the 15th of March, you'll buy another $1,000 of fruit at this price. And on the 15th of April, you'll buy another $1,000 at this price. And in all, you'll get an average of dollar cost average at around this price level. If you were to use a fixed price DCA plan, the FNR way, you will also buy $1,000 of fruit each month, but the difference here is that you will only do so at specified price level. So what happens to the unspent money if price does not touch any of these specified price levels is that the money that you intend to invest in that month will be brought over to the next month for your investment. So what you will need if you were to use a SNR way DCA plan is that you need to have your monthly SNR level being determined. So here you have two monthly level SNR. You want to have one higher and one lower monthly SNR. So in a way, you can think of the lower monthly level as the support and the higher level as the resistance. So in January, the price did not reach any of the monthly level, so you could not be investing any amount into fruit. And on February, the price reached the higher money level, and you invest $2,000 into fruit. This $2,000 is an accumulation of the $1,000 that is unspent from January and the $1,000 that you intend to invest in February. And in March, price reached the lower money level over here, and you'll buy another $1,000. And in April, price reached the higher money level, and you'll buy another $1,000 here. And in all, your dollar cost average into fruits will be around this price. So if we were to contrast between fixed time-based DCA and fixed price-based DCA, the main difference is that if you were to use a fixed time DCA, there's a chance that you might be accumulating your assets at an extremely high price over many months if price is to stay range bound at a high price level. The advantage of a fixed time is that it's easy to implement and you will not require much monitoring or any technical analysis knowledge of price in order to implement a fixed time based DCA. That's why the fixed time based DCA is not the most popular investing approach that most people will use on a monthly or weekly basis to accumulate an asset. The SNR way is a fixed price based DCA. The advantage is that it's a more controlled way of doing your DCA accumulation. It tends to help you to avoid extremely high price dollar cost averaging in. It does require effort to determine ideal price to DCA and to constantly be aware of where you need to actually accumulate your asset at that price.